Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
This weekend, we are going to talk about three topics. The first one is beyond ESOPs, where we will talk about how you, as a non-resident Indian, can diversify your wealth across the Indian market and take advantage of India's growth story. The second is green hydrogen, where we will dwell into the promising world of green hydrogen and its pivotal role in transition to sustainable energy. The third is an overview on hybrid funds, where we will look at hybrid funds and whether it is the right time to invest in them and are they better than equity funds. So, if you are interested in any of them, click on the description below to register.
On this channel, we've probably mentioned portfolio review many times in guiding investors towards a better investment process. So in today's video, we thought we'd break down what a portfolio review is and how you can do this. We believe that a portfolio review is a very powerful tool in sustainable wealth creation. So we're going to look at 5 important elements of a portfolio review. So the first element is something where we'd encourage investors to think about why they made certain investments. Now, when we come down to the reasons, you'd realize that there are broadly 3 reasons why investors make investment decisions. The first is in terms of performance. So, when investors make a certain choice, they have a certain return expectation that they've kept in mind. So, when we're coming back to doing that review, you want to understand whether that objective has been met, whether it can be met in the future, or whether it is not going to be met. And that will drive the decision making going forward. The second reason could be a particular goal that the investor has. So sometimes we make investment decisions for specific goals. So for example, somebody who's saving for their daughter's education may have made an investment to provide for that particular goal in the future. So then we have to see how far away are we from that goal and whether any action needs to be taken on those lines. The third is when the investor is a do-it-yourself investor, they might have formed a proper investment thesis around why they like a particular investment, and then it becomes important to see whether that thesis is still valid or if some changes have to be accommodated into this process. So when we come back to the table and we look at why we've made certain decisions, it gives us a good insight as to what we need to do next. The second element that we're going to look at is with respect to risks. So have the risks overall changed? So if we were to look at investment decisions made in a particular market context and then after 6 months to come back and look at it, we might want to understand what kind of macroeconomic changes have occurred. So have interest rates gone up? Could that impact your investment decisions? Or for example, what are currency rates looking like? Would import-export affect your investment decisions? And you can even look at things like global sentiment, flows. So there are many other moving parts that could influence the risks in your investment choices. So revisiting the risks and understanding whether the changes in these factors are positive or negative can give us some guidance on what the next step should be. The third element that we're going to look at is position sizing, because now that we know whether risks have risen or decreased and their associated impact, we also want to see whether we've optimized our portfolio weights for performance as well as risk management. So position sizing is something that most investors don't pay too much attention to, but it's something that requires some pruning. So imagine you had made an investment decision that accounted for 5% of your portfolio and that doubled over a period of time. Then that particular decision may occupy close to 10% of your portfolio, and you need to decide whether that is the right level of exposure, or if you want to reduce it because you want to reduce risk, or if it is fine because that's the optimal risk that you'd like to take. So moving on to our fourth element, which is asset allocation. So most investors tend to only review certain parts of their portfolio regularly. So for example, if somebody is a stock market investor, they might only be focusing on their portfolio of stocks and they may not pay enough attention to their mutual fund portfolio or other asset classes that they may have invested in. So coming back to the table and looking at your overall asset allocation and seeing if you have the right level of exposure to different asset classes makes a lot of sense. And now coming to the fifth and final element of the portfolio review, this is about liquidity. Now many investors don't actually plan on how to structure their liquidity in the portfolio because selling decisions are something that people don't talk enough about. So it's important to come back and see how much cash you want to maintain in the portfolio. This is known as a cash call. Sometimes it makes a lot of sense to have more cash because you might anticipate more opportunities in the future and you might be a little risk averse in the current market context. So cash calls as well as sell calls are very important in wealth creation. We hope that this video has helped you in your journey as an investor. We wish you a very safe investing experience going forward.